you can't win big contracts. It's very difficult to recruit good senior staff. What you realize when you go through a few of these cycles is that best practice for the capital markets is nonsense. It's
partner at Unity Group, Callum Laing.
As an entrepreneur, when you win a contract, you reinvest that profit into growth and team and building. You're constantly thinking in the future. You get this immediate culture clash between entrepreneurs and the capital markets. To them, reinvesting profit in future growth is ridiculous.
If people have never done it before, there's that terror or fear of having to work with a private equity firm, which feels very intimidating. The likelihood is you're probably going to smack your face at least the first 5 times. So get some folks around you who probably made those 15 mistakes before you. How do you build successful long-term business partnerships?
Yeah.
So before we begin with today's conversation, a word from us at Open Equity. You're probably watching this because you're looking to scale and exit or IPO your company successfully. Well, we have a wealth of resources that are designed exactly to support your success, from workshops, from free guides, from downloads and things like that. There's loads of links in the description. Let's get on with the show. Callum, thanks so much for joining me. Really appreciate it. It's great to chat and wonderful to see you as always.
Yeah, good. I'm really looking forward to this.
And you are beaming in from Singapore, which you've made your base for the last, 15 years or so?
Yeah. So I did actually come to Dubai, but obviously not often enough to get an invite to your studio. So hence we're doing it digitally. But next time I'm in town, we'll do it face to face.
We'll do part 2.
The version 2.
That's always good. Yeah.
So I won't cover any valuable stuff on this one, just in case.
No, thanks very much. Well, look, I really appreciate you coming in. The thing I wanted to start with, like we were talking before, is around fundraising and raising capital and things like that. It's something that most entrepreneurs are not very good at and or have no idea how to do. And you've got a wealth of experience in private markets and public markets, and also a particular kind of, I think, way of doing it now. So I'd love to start there. Why are people so useless at it, and how have you learned to help people get better at it?
Look, I was useless at it for many years, and in fact, I don't think I'm particularly talented at it. I just learned through trial and error where the money is and what people with money are looking for. So I think if you're an entrepreneur, you spend all of your time focused on creating client value, and that's like 100% of your mindset and effort. And often you assume if you're creating enough client value, you must be creating shareholder value. But actually the two things are very separate. And so it's only when you really start to think of yourself as an owner of a business. And for me, this only came when I became an owner of somebody else's business, that for the first time I actually thought in terms of shareholder value rather than client value. And that changed a lot of how I viewed things. You kind of, when I was looking at this business that I was about to buy, I was kind of looking at some very strange things. So they had this client that they served that they were losing money on, and I said to the owner, like, why are you doing that? And they said, well, it was our first client we ever had, and I can't really
like them.
I just they're so nice. I said, if I buy the company, I'm going to fire them. And he said, yeah, but you can do that. I can't do that. Thought, what an idiot. And then he had a staff member that was absolutely useless, but he just felt guilty. And again, like, I could get rid of them, but he couldn't. And again, I thought, what an idiot. But now I had this new set of glasses on. When I went back to my own business, I realized I was doing exactly the same thing. I had clients that weren't profitable. I had staff members that were long overdue. So part of it is understanding that shareholder value. I think the other thing is that most of us as entrepreneurs, we don't have any money. And so it's difficult for us to understand how investors think about money. And so really kind of the evolution for me was becoming successful enough that I became an investor, and I started looking at investment opportunities, and so you kind of have you're on the other side of the table now, and you have startups come to you and ask for money, and what you realize is you can't bullshit a bullshitter.
You just get a
Suddenly,
million pitch decks basically telling you, I've got a 7 trillion TAM opportunity, and I'm
I
going to
just get
disrupt
1% of the
globally.
market. Exactly,
Yeah.
exactly.
Yeah.
And you just go, look, it's just it's just
I was
rubbish.
very excited as well. I always think like also lots of exclamation marks and emojis and stuff like that, which is like a bit of a red flag.
That's what
It
investors
just
are after.
seems a bit nuts. Yeah.
Yeah, I mean, it's kind of like, I love startups in a condescending way. The problem with startups is everything is all in the future, and actually, all of the work I do is with business owners that have reached at least $1 million in net profit. And the difference is startups can only talk about what they're going to do in the future, and it's bullshit because it's just made up fantasy. Whereas somebody that's already reached $1 million in EBIT and profit, they've got great stories about how they got there, and that to me is much more interesting. But yeah, just sort of being on the other side, looking at it from the point of view of an investor, and then you start to look at how deals get done, and when I was raising money for private companies, I learned a couple of hacks. Like I learned that if you have an advisory board, you can leverage off that advisory board. It gives you credibility. It gives the investor some security. That sort of made a big difference for me. I went from struggling with one of the companies I went from struggling to raise money at a $1 million valuation to adding an advisory board and being able to raise money at a $10 million valuation. Nothing had changed other than I had some grown-ups sitting on an advisory board. So that was kind of one bit of learning. But then I kind of got into the public markets and I started to do capital raising. I always kind of assumed it would be much more sophisticated in the capital markets. And it's not. It's like it's
more,
just much more expensive.
It's very expensive.
But the advice is definitely more paperwork. But the advice that you get from investor relations companies and professionals is still the same advice that you get as a startup, which is basically have a nice deck and then go and knock on 1,000 doors. And it kind of, I did that. I did those endless road shows and spoke at endless conferences. But I remember I sort of had an epiphany on stage when I think I was in Frankfurt in front of about 200 investors, just kind of reeling off my presentation. And because I was so familiar, like it was at the end of a roadshow, so the presentation, like I wasn't thinking about it. I was thinking about something
autopilot.
Else. Yeah. And I was thinking about who my investors were. And I thought, like, I know almost all of them. We're doing all of this work to bring in new investors, but actually the people that have invested, 90% of our investors invested because they knew me, trusted me, and liked what we were doing. And then there's a screenshot I use in my presentations now, which is from the court case of when Elon Musk was trying to get out of his Twitter deal.
I was just going to say, I was just going to say that was great. Yeah, sorry, carry on.
And it's brilliant. So it's this text exchange between him and his friend Larry Ellison, CEO of Oracle, and he basically says, "Hey, look, I'm thinking of buying Twitter. Would you be in for something?" And Larry says, "Yeah, definitely. How much are you thinking?" Elon says, "Couple of billion." Larry's like, "Yeah, all right." And although like I'm not doing deals at that level, it's actually exactly how all my deals are done. Yeah. So it's people in my inner circle that I know, like, and trust saying, "Hey, look, I'm involved in this company. I think you would like it." And look, if it's people I really trust, so I have sort of an inner circle of 4 or 5 people, I'll just chuck money into it. I don't even bother doing the DD. I know that it's covered. Then there's sort of my second tier of network that at least I'll look at it and do some DD and see whether it's worth it. And then there's everyone else. And I'm just not going to look at it. And so this whole advice, spamming people endlessly with your business plan is just really, I don't think it's evolved in 40 or 50 years.
It's probably got worse, right? Because I mean, your LinkedIn inbox probably looks like mine, which is just every day it's people connecting with me. Either there's the very hypey, I've got something that's going to be $1 trillion thing next week, or even if it's quite a good thing, it's just the first interaction is like, I'm raising for XYZ. Can I send you the pitch deck or something like that? And I kind of think, like, can you just romance me a little bit and get to know me a little bit? And then maybe, exactly like you're saying, maybe we can build a relationship and maybe we could do lots of deals together. But I need to get to know you a little bit first.
Yeah. So I built I built a community around capital raising and how to be a capital raiser and how to be an introducer. And I interviewed some very good capital raisers in that community. It's a free community to join at guildmembers.com if anyone's interested. But one of the guys,
sign up, get the resources. Yeah.
Click down below. So one of the guys that I interviewed is a guy called Ron Diamond, who runs a series of he's part of Tiger 21, which is this ultra high net worth global network. He runs a group of family offices, and he had this mantra. So he's got his own fund, but he will never pitch to a family office on the first meeting. And he says sometimes, like, he gets introduced to family offices because he has access to these deals, and he meets them and they will say, like, what's the deals? What's the best deals? And he has a rule. He'll never, ever pitch on the first meeting. He will always try and add value first. And the easiest way to add value is to introduce them to someone like them. So if you introduce a family office to another family office, normally they're pretty grateful for doing that. And so that's kind of one of our key methodologies, is basically build networks of the people that you want to be surrounded by. And even if they're not interested in you, because they probably aren't, but they will be interested in the other people in your network. So if you can surround yourself by angel investors, if that's your space, or hedge funds, if that's where you're at, then other people will want to be in that network to reach that group. And so, that's kind of the approach that we take now. And it's much more relaxed. It's much more focused on adding value first. And then weirdly, I mean, I always talk about capital raising is either a huge slog or it's weirdly easy. And it's weirdly easy when people know, like, and trust you. And that's kind of the sort of the approach that we work with now.
Yeah. Well, I mean, it's funny you said it, because actually I hadn't noticed that, but then when I last saw you and you were giving a keynote and talking about that, I've noticed it since. Is I've met a lot of people who are very successful capital raisers or whatever, and after I meet them, the first thing they do is say, "Oh, you should speak to such and such or such and such," and introduce me on WhatsApp, and then I get in a conversation and that leads somewhere and da da da, and it is 100%. And I didn't used to do it as much, maybe being too introverted about it, but now I've taken your advice and so on and so forth, and it just accelerates relationship, because you're generally like, okay, so you want to connect with these kinds of people. Well, I know somebody who works there, or I know someone who is in that market. Perhaps you guys should have a chat or something like that.
Yeah, it's like a cheap brand. It doesn't cost you anything, and now they owe you.
Yeah, yeah. And why? I mean, because relationship building and partnerships seems like a theme that's kind of gone through your career. Were you always kind of thinking, let's build partnerships, let's build relationships? Was that something that comes naturally, or was there like a kind of moment when you thought, this is working, this is giving extra leverage, or how did you kind of get across partnerships and those kind of
things? So it came about because I I'm rubbish at sales, and I kind of I've got friends, people like Daniel Priestley, that when they were young entrepreneurs and growing up and working for other people, they were in those kind of cool room environments where it's just pick up the phone, cold call, and kind of had that real sales thing driven into them. I never had that. And so I kind of never got comfortable with it. I would try and force myself to do it, but it just wasn't really my
No,
thing.
it's not for me either. I mean, it's like make 100 cold calls, and I'm like, I'm not making one cold call. I would. Sounds awful.
I can procrastinate on that for months.
Yeah, exactly.
And weirdly, if my PA puts a phone call in my calendar, I'll make it without thinking. But a list of
it's
people,
it's a very good point actually. Yeah, it's funny that.
So I've used that as a hack in the past, is to get my PA to do that.
Yeah, it just slightly reframes it, doesn't it? But anyway, sorry.
Yeah, it does. And I think that's kind of part of it, is that you sort of, there's that nice British thing of, I don't want to disturb someone. But yeah, partnerships always struck me as a good idea. And I think it started because I wasn't particularly successful, or as a struggling young entrepreneur. And I couldn't buy things. The things that I wanted, like adverts in newspapers and magazines, I couldn't.
Oh, I thought you were going to say green Lamborghinis or something like that. But yeah,
well,
adverts were also,
that as well. But so I had to come up with ways of giving them value that weren't capital, and so I'd end up writing columns for them, or I'd make them media sponsors of events, so that in return I could get an advert in their magazine, and I again sort of made tons and tons of mistakes, and but eventually sort of worked out a methodology of building partnerships, which ultimately my first book is called Progressive Partnerships, and
buy now on Amazon. Yeah,
that's the one. But actually the it's strange, because the methodology I use for that has ultimately sort of been at the heart of everything that we've done since. And one of the key ideas is, you don't, like, if you want to do a partnership with Google or McDonald's or Nike, they're not, like, if you're a small business, yes, that will transform your world, but they're a nightmare to deal with, because you're dealing with an employee that, it's, even if it's the perfect partnership for the company, it's not the perfect partnership for that employee. They're not going to get any credit if it goes well, and they're going to get beaten up if it goes badly. So they'll waste your time, because it's more interesting talking to you than it is doing work, but you're not going to get anywhere. And so what I realized was that what you want to do is do partnerships with companies that don't matter to you, that will make no difference, but you get that first partnership done. And then you leverage off that partnership to get the second partnership done. And you leverage off that one. And none of them need, and basically what I realized was that most people don't actually deliver on these partnerships. So as a young, hungry business, you're desperate for this company to promote your logo, or to offer this to your clients. Most of them don't do it, because while it sounds like a good idea in the meeting, then they get distracted by stuff that actually generates money. And so everyone just gets frustrated with partnerships. And so my philosophy was, assume it's not going to work, which sounds really negative. But if you have a very low expectation, everything's upside. And basically you win anyway, because you can now use the fact that you've got 3 partners already to get that 4th partnership, and then that 5th partnership, and that 6th partnership. And then what you find is the big companies start coming to you, because they start seeing you partner with these other companies that's on their radar. And then they want to know why, but they also assume that those companies have already done DD on you, and you must be doing something right. And so now what happens for that employee is, it's a career risk if they don't partner with you, versus it being a career risk if they do partner with you. Because if they don't partner with you and you turn out to be very successful, then they're going to get beaten up for not partnering with you, because you were already partnered with all of their competitors and everything else. And so that kind of building credibility and building trust through leveraging off other people's hard-earned brandage has served us well in everything that we do now.
It seems like a smart way to do it. Yeah, because I mean, same principle I suppose with acquisitions is there's a temptation, I think, for first time or early time founders to think I need to build everything myself and do everything myself, whereas another company has all the customers you need, or another company has the management team that you want to hire, or same principle in partnerships. They may have whatever it is, but I mean that mindset shift from I need to create it all and almost it's me against the world versus actually everyone can win and feels like a big mindset shift that some people get and some people don't.
Yeah, and so interestingly, it comes up a lot. So one of the businesses that I run is called the Veblen Director Program, which helps individuals get their first board seats. And actually, that idea of you not providing the solutions, but introducing to people that have the solutions already, that's very counterculture to if you've grown up as an employee, your whole internal brand is around delivering the results yourself, being the go-to person. And so what I have to try and get people out of that frame of mind is that because if you're sitting on the board of a company and they've got a problem, if you can only think of that problem in terms of can you solve it, there's a very tiny,
limited, right? Yeah.
it's very limited.
Yeah.
But instead, if you said, okay, someone I know must know the answer to this problem, you provide just as much value as a board member if you connect them to the person that solves the problem than if you solve the problem yourself. And actually, to try and force our members to think like this, we actually encourage them, their first board seats, we encourage them to do it in industries that they know nothing about. So go and sit on the board of a company in an industry you know nothing about. Because firstly, it forces you to think like that and ask much, much smarter questions. Whereas in your own industry, you tend to assume you know it all and you want to look like you know it all. Whereas in another industry, you'll ask the right questions. But also it stops you becoming an unpaid consultant. Because we're all nice and we sit on the board and the founder says, oh, I'm really struggling with this. And you think, I'll just go in for half a day. I can fix this for them.
Yeah.
And then suddenly you're just an unpaid consultant, which isn't the purpose of the game at all. Whereas if you come from a construction background and you're now in a med tech business, you would never go, oh, you know what, I'll come in for half a day and see whether we can knock something up. Like you go, okay, let me see if I can find something that can help.
Yeah, I mean, sorry to interject, but it's a really good point because actually we actually started something in an industry that none of us had any experience in with a couple of partners. And it's been really liberating because I know that I have no idea how to, or the couple of us have no idea how to deliver the thing without getting too specific about it. And it's been really useful because my tendency, particularly in tech stuff, would be, well, exactly as you're saying, I'll jump in and do it. But not knowing at all how to, in this case, it's kind of constructing something. It's really useful. Because I'm just not going to think about it, and so I'll just focus on the stuff, the kind of deal making aspects, and I'll have to find someone else to do that.
Yeah, interestingly, in entrepreneurship, I've been given this example recently. There was a Kiwi guy here in Singapore who worked for one of the big banks, and he had built this very successful chain of sandwich stores, and then he leveraged that to build a coffee brand, and all the time he was working full time in the bank, and I got to know Ben. He was a very smart entrepreneur. But what I realized was he had built these companies so well because he had to build them just in his evenings and in lunch breaks, and so he had to make sure that the systems and the people and the processes were all there and could survive without him. Whereas most entrepreneurs, when we're starting out, we'll just go in and fix stuff because it's quicker to fix stuff than to whereas he couldn't do that. And so he built these businesses. And yeah, I kind of really, really admired him for doing that. It's a harder journey, but I think it forced on him. He ended up a much better entrepreneur than most of us because he had that discipline of not being able to.
Let's talk about. I want to talk about. There's a lot of folks who are scaling up towards an exit or an IPO. You have a wealth of experience in private markets, public markets, a nuanced approach on public markets. But perhaps, I mean, first to start with a little context on that evolution of private v public, and then where you've kind of arrived at in terms of the bond offerings and things like that.
Yeah. So yeah, so we've been in the capital market and the public markets for 10 years now. And I like to think we've made every mistake going in that journey. They're really, really tough. And they're really, really tough because as an entrepreneur, you remember I was talking about client value. Like you're constantly thinking in terms, and when you win a contract, you reinvest that profit into growth and team and building. You're constantly thinking in the future, and that's how you make profit, because you create value like that. And then you go into the capital markets, and it's the complete reverse mindset. Investors and traders don't care about the future. They're like, the longest time period they can think about is 90 days. And most traders think in terms of 8 hours, and often less. And so to them, reinvesting profit in future growth is ridiculous. Like, and to be fair to them, the way they create value for their LPs is by making short-term profit. So you get this immediate culture clash between entrepreneurs and the capital markets. And that took us, it's, and look, you see every entrepreneur go through this. Everyone that goes public basically says, it's the best day of my life. And then 6 months later, they're suicidal and taking their company private again. It's horrendous. And it's just such a culture shock. So we went through all that. And we've now taken so publicly over 100 companies public, and we have kind of a group structure. We put companies in, and so when I say we, it's myself and Jeremy Harbour, who my business partner in Unity Group, and for his interview, click here. But yeah, we kind of went through. We solved a problem for small business owners like us, which is, if we can help put groups of them together on the capital markets, you get over that scale paradox that small businesses have, that you can't reach, you can't win big contracts. It's very difficult to recruit good senior staff, all of those sort of things. So we designed this model from the bottom up to solve the problem for small business owners, and we just followed best practice for the capital markets. What you realize when you go through a few of these cycles is that best practice for the capital markets is nonsense. It's what they've done is they've said, okay, this is what the biggest companies in the world do. Follow what they do. And it's terrible advice. Like it's
what was the advice?
You shouldn't be doing. Well, it's kind of things like you want to have lots of liquidity. You want to spend a fortune on investor relations. But you're dealing with, first of all, the people that are giving you all this advice are charging you a fortune for it. And you realize that's their priority. It's not your well-being. And then you've got traders and hedge funds and everyone else that realize you've got no idea what you're doing, and they can manipulate your price. And basically, it's very difficult to manipulate Apple's price because there's just such volume going through it. It's very easy to manipulate the price of a company that's 100 million or even like $500 million or something. And so people do, like, that's the game. That's how they make money for their investors. And entrepreneurs are just not equipped to deal with that. And so, and we kind of thought naively, look, if your revenue goes up and your profits go up and you pay out dividends every year, then your share price would go up.
Great, yeah.
That would kind of make sense. And that's so that's kind of the advice that you're given as well. So just deliver good results. But then we did that, and this, everything went up that way, apart from the share price that was going down that way. And what you realize is that there are shareholders that don't share your vision. They've got different priorities. They've got a tax bill. They've got got other things they want to spend their money on. And so what happens is you're constantly just in this cycle of trying to chase new investors. And it was super, super frustrating. It was very difficult to use our stock as a currency to do acquisitions when it was very volatile. And even though we knew what we were doing was solving a huge problem for small business owners, it wasn't working if the investors aren't getting a return as well. And so in the end, and it took us too long to work this out, but in the end, what we did was we said, okay, look, let's reverse engineer the perfect IPO if you're an investor. So forget what we've been doing. If we were to invest in somebody else's IPO today, what would we want to know? And from experience, we said what we want to know is that nobody's going to sell their shares. Like that's the thing. And interestingly, nobody talks about this, but I've had lunch with one of the top economists of the private banks, and I said, what makes share prices go up? It's the macro environment and it's the interest rates and all this. And then you talk to analysts, and they say, well, it's all about the executive team and it's all about the moat. And then you talk to traders, and they tell you it's like cup and handle thing, sit candlestick maker something or other. And
I forgot about that. I remember I did have a brief period of doing, I think like everyone, of trying to do and then you learn about technical analysis. These candlestick things was insane. But it was like, anyway, we won't go down that road. Well, sorry, carry
on. And look, they believe it, and anyway. And look, all of those things have an impact, clearly, but fundamentally, and what nobody talks about, is it's just supply and demand. If you've got more demand for stock than you have supply, the share price goes up. Now, the economy and the executive team and the traders can all have an impact on creating that demand. But fundamentally, and now the problem is, 30, 40 years ago, when you and I were just a twinkle, a company going public was a really big deal. It was sort of newspaper headlines, and you'd phone up your broker and try and get hold of the stock. And it was very exciting. Today, and basically as an investor, what else could you invest in? Like government bonds or the stock market? There was not a lot of choice. Whereas today, investors are inundated with opportunities. The biggest companies in the world are still growing at like 25% a year, sitting on 100 billion in dry capital. And then every man, woman, and child and their dog is raising capital for a vet. Like there's so many investment opportunities. So another company going public is just not exciting. And so that demand has been diffused across a million different projects. And on the other side of that, for years, everyone's been told an IPO is an exit. And so you've got the founder, you've got the staff that have been underpaid for years but have been given stock, you've got early investors, you've got the investment banks themselves. As soon as they list, they all spew out their stock in the hope that somebody's going to be on the receiving end and buy it. And they're not there anymore. And so this is all kind of going down. So we basically kind of rewrote the game for us and said, okay, we're not going to play by their rules. When we take a company public, everyone is going to be locked up for 5 years.
5 years.
Everyone associated with the deal is locked up. And it's basically this constrained stock model. Which the markets hate, because how do they make money if nobody's trading stock?
It's quite interesting because it's almost like, because like with a private equity fund, it's a 10-year lockup plus indefinitely in reality. But that's quite interesting, that 5-year period. Okay, sorry. So the markets hate it, but I assume it.
So the market hates it, but it's perfectly legal. If every Tesla shareholders refused to sell today, the share price would spike again. Like so, so that's what we did, and then, basically, if you think about it from an investor side, well, hang on, if nobody can sell, this can only go up. So now I'm interested in buying. So now you have more demand side than you have supply side. So then we can leak out little bits of stock. So not huge deals, but this is the point. While everyone will tell you need to focus on liquidity because otherwise you can't have big investors coming in. actually, if you can control the share price, you can do so much more. So if you can say, look, I can take a long-term vision on this, I can be long-term greedy rather than short-term greedy. Our 5-year goal is to grow this to $1 billion plus, and then cross-list onto a bigger market where there is liquidity, but we're big enough to fight our own fight at that point. Then it gives you lots of options. So you don't have to worry about doing these roadshows. You don't have to spend a fortune on investor relations. People will come to you and say, hey, look, there's only 10 grand's worth of liquidity on the market, but I would like to buy $1 million. And you can say, well, we can do an off-market trade on that. So again, you kind of skip going through this whole process, and then you know exactly who's selling if they do try to sell, or you can sell them locked up stock. So yeah, it's kind of interesting, and it seems, when we talk about it to people in the industry, they're kind of like, you can't do that. And again, it's just because most people on the capital side just don't have the patience. Like they can't think 5 years.
I mean, 5 years is for most, they can't think 5 minutes. Yeah, so 5 years is nuts. Yeah,
exactly. And so, one of the big questions we had when we designed that model was, well, would a business owner swap their private stock for public stock if they're still locked up for 5 years? Well, if that means that their stock's going to be worth 5-10 times what it currently is today, and nobody else is selling against them, so their share price is always like, it's not something they have to worry about. They get grief when it goes down.
Anxiety. Yeah.
They can just get on with growing the business. And I think, sort of going back to your original question, like in terms of the pros and cons of going public, as a single company, I don't think there are a lot of pros of just going public for the sake of it. I think there's easier ways to raise money now. I think the regulatory overhead's a pain. But where it does still win is for M&A. There is no question that when you approach a company as a public company, you just have so much more credibility. They can see your share price. They can look at your audits. You look like you know what you're doing, even if you don't. And you've got this currency of this stock that you can create and use to do acquisitions, which is much more powerful than private stock, because the promise of, hey, I'll give you stock in my company. Oh, great. What do I do with that?
Also worthless. Yeah. No, amazing. But so how to do that step by step then? So let's say I have a between 5 and 10 million EBIT company. I want to scale it through acquisition. Like how do you actually go about doing that?
Yeah. So I mean, that's how long have you got?
An hour in itself.
There's quite a few.
But maybe a better question is actually like, what's a good example of one that have kind of gone through that? Because I think a lot of people kind of love the idea, but kind of how would I actually think about that as a path for scaling my company?
Yeah, I mean, I think, and this is going to sort of sound like I'm selling my own dog food.
That's fine. Do that. It's free market.
Thanks. Look, going public is really tricky and a pain, and you're basically going into a market where everyone knows more than you and is going to exploit your naivety. And so what we've done, so in the example you gave, companies doing like 10 million at EBIT, whatever, we will typically take them public. We will take on about 90% of the costs, we being Unity Group, to get them public, as long as they are looking to grow through acquisition. Because then what we can do is we can go out to our network, and we've sort of spent a lot of time over the last 10 years building an ecosystem of people sitting on boards, of people doing M&A transactions, that we can say, hey, look, we've just done an education deal, so we're looking for other companies in the education space. And then we can go to other education companies, for example, and say, hey, look, we've got this publicly listed company. Would you like to be a part of this journey? This is, and the agglomeration model that we sort of designed at the beginning, bottom up, was to leave those companies with their own brand, their own autonomy. It basically becomes a cooperative, publicly listed cooperative of small business owners. So it's in their interests to help each other, but they can't tell each other how to run. And that's super appealing to entrepreneurs because we hate being told what to do. And the other advantage of that, so that first company that came in has the credibility in the industry. Unity Group has the credibility in the capital markets. Like if we tried to pretend we were experts in education, that would fall down pretty quickly. But we've got the people in the company that understand the market, and they can also say to us, don't do that company. Like, I know it looks good on the outside, but we know the backstory and it's one to avoid. And so you kind of have very sort of real DD. And one of the other things that we piloted and now make key is that when a company comes in, we can reverse the deal within the first 12 months if they fail to meet 80% of their last year's EBIT. And that was really, really important because
that's a good point. Yeah.
What that meant is anyone can hide stuff in DD. You know, if Arthur Anderson
and also next year is going to be the best year ever. I mean,
always,
it's always like
always.
that.
This year wasn't as good as we were expecting, but next year, and so basically by giving you that option to unwind the deal, look, you wouldn't, if there's genuine reason and there's 79%, you're not going to do the unwind. But if there's something comes up that wasn't clear in DD, or something else, and because you're not merging the companies, they're basically independent, sitting underneath each other, it's super easy to unwind the deal, and everyone's protected. Nobody loses anything, and I think that makes the whole process. I think a lot of what we've spent time on over the last decade is just trying to remove the risk, both for us, but also for the company coming in. That's kind of our approach. So I guess, a long answer to your question, but basically,
no, that's really interesting. Yeah. But it sounds like what you've nailed is but what you nailed is kind of managing supply and demand, as opposed to walking into a absolute nightmare of not being able to manage that. And then, yes, managing the supply and demand, take the company public, but people are locked up as a result of that. And then particularly focusing on building through acquisition, which I've found, my experience is mainly in fact, pretty much entirely in private markets, and financing roll-ups, particularly if there's a pipeline there, is fairly easy to do, as opposed to financing growth, and trust me, it's going to be wonderful, is quite difficult to get people behind. And do you find that as well, as actually if you've kind of take the thing public, it looks very credible, plus we have a pipeline, it's like, to your point about being de-risked, you've kind of de-risked a hell of a lot for an investor at that point.
Yeah, and I think you and I have touched on this before. Like, even if you're going to do it in the private market, what you want to be very clear on is the end goal. And so, and I think you mentioned, or like I said, so I told a story before. I've got a friend in private equity, and I spend a lot of time criticizing private equity because it's fun. But
should do that. So do I.
And the results are terrible. But and like they hate what we do because like the idea of giving the entrepreneur autonomy just goes like to them. And so my mate, we go out for lunch about once a quarter, and he takes the piss out of me because I'm talking about entrepreneurs doing stupid things. And he's just like, just fire them and put a 32-year-old with an MBA in, that'll do what you're told. And but the difference is we get over 1,000 applications a year from companies that want to go public. He's lucky if he can find one that will put up with him. That's the sort of the difference.
It's amazing. I mean, that's a whole separate thing. But sorry, carry on. Carry on with that.
No, well, just to finish that point is where it does get useful is he could give me a complete prescription of what he would buy. So he said, look, if you can put together 5 med tech companies with a combined EBIT of this, we will pay this for it. And so that's the only way I would do it in the private market, is if I've already got the buyer lined up and committed.
Yeah, really, really good point. I remember we have talked about that, and that's exactly what. I mean, there's two things there. One is we get flooded with people who want to scale their companies up and exit or IPO because I didn't realize it, but there's that shift from the terror or fear of having to work with a private equity firm, which feels very intimidating, especially if you've never walked inside a private equity firm and realized none of them have ever run a business before. But then as a result of getting that deal flow, and then but taking some of the lessons, like you say, of in the kind of grown-up space of saying, before I'm going to embark on this, weirdly, I'm going to reverse engineer success, know there's an abundance of buyers at the end of it, probably know what the transaction and the company needs to look like, and then map out the A to B. And I've always found the joy of private equity is the nice thing about finance people, and I mean this very politely to any finance people doing, is that it's quite simple and prescriptive. I think I've told you that story. I won't name names, but being in quite a large PE firm's boardroom, and I was doing this very hand-wavy, excited pitch, and he kind of cut me off after about 20 seconds and said, "There's a line at the bottom which is EBITDA, and if it can help this, I'm interested, and if it doesn't, please just leave this boardroom and leave me alone." And it was actually really useful, because then it was like, okay, great. If you just tell me that, like you said, med tech, 5 companies, succession management team in Germany and the Belgian region or whatever, then I can just go off and do it. This is much easier than kind of hoping that I'm going to make millions in the future.
It is much easier, but it's also so weird. Like, their whole world revolves around the balance sheet, and anyone that's built a business knows it's all about people. And there's just and I think, look, it's.
But they're not really people that they're not really people who like interacting with people, though. That's finance, but they love spreadsheets and not talking to people. So,
absolutely.
Sorry to every investment banker watching this.
It's weird that you've got so much of the economy is in finance that is all around businesses, and yet businesses, small business especially, which is half of the world's economy, is completely disconnected from finance. It's quite you would have thought we'd all speak the same language, but we very much don't.
Yeah. And I'd also love to talk about wins along the way, because I think, particularly for, I probably spoke to 5 folks this week who haven't sold a business before, want to sell a business, want to maybe take some risk off the table and so on. Like, what were some of those kind of moments where you were able to take some risk off the table and you kind of can take a break from having to work 24/7 for minimum wage and it being painful?
Now I do it for a high wage, but
now it's for free and you pay other people. It's like negative.
Yeah. Look, I think I've sold businesses along the way. I do end up talking more about my mistakes than about the wins,
but that's really useful.
That tends to be the most use. And actually, the first time I met Jeremy Harbour, I had bought a business for no money down, using money from clients of that business, and signed up it was a sports events company. It was a yacht regatta, and I signed up a headline sponsor for it. It was a 1-week event once a year, super glamorous, yachting in Koh Samui in Thailand. Absolutely beautiful. Brilliant. Making about $250,000 net profit a year, which in
that one event.
Yeah, which in Thailand goes a very long way.
Yeah.
And I remember met Jeremy for the first time. I think it was the first harbour club he'd ever done outside of Europe, and it was only like a second or third. And I was telling him about this business, and I told him how good it was. We get to go out on yachts, and it's just so great. And he's like, "Yeah, that's why you should sell it." And I was like, "No, it's spinning off $250,000. I can probably grow it to $500,000, and we can make it luxury. We can do this and this." And it's like, "Yeah, all of those are reasons why you should sell it." I was like, "Nah, I'm gonna have to agree to disagree." And then, 6 months later, the global financial crisis hit, and over. God, he was right. and it ended up taking me sort of another 3 years to build it up to a point where I could basically give it away for next to nothing. But having said that, I've had a few wins along the way as well, and I think what we've tried to do, certainly in the last 10 years, is make sure that we're trying to build these more like a series of billion-dollar groups of companies, but we're taking money off the table all along, and I think it's afforded a nice lifestyle, and it allows you to take risks. So, for example, the Veblen Director Program, which I launched, was because I saw a need to help people that were on the outside. It's a very exclusive club, that sort of boardroom space, but I found a way to get outsiders into the inside. But I didn't need to kind of make that profitable from day one. I could kind of grow it and filter the people that I brought into it to make sure they were the right people. And so those are kind of the advantages that you have. You can take more shots.
Yeah.
And as Oprah Winfrey says, you get to wear nicer shoes along the way as well. So,
but I mean, I like that. I mean, taking risk off along the way, because I think as well, like, again, what I think is great about having this conversation is there's a lot of nuance and experience that then leads to a nuanced answer. Whereas, a quite common, sit on LinkedIn all the time is just build the company up and then sell it and everything's wonderful and here are the 4 steps or something like that. And it never works like that, because there's going to be some deferred payments, or there's going to be some earnouts, or there's going to be whatever. But actually being smart and prudent about perhaps de-risking along the way, as opposed to this kind of slight Hollywood fantasy is
yeah. And look, I kind of made a lot of mistakes and didn't do that. Watching your bank account soar to tens of millions of euros and then plummet again, and thinking, if I just put 10% of that aside, it would be good. So I had to make those mistakes, and of course, being an idiot entrepreneur, I always think that this time's different. But as I think I've got older and I've had kids, I've sort of done more of putting things aside and been a little bit more sensible with my own investments. But I think the other thing in terms of that kind of whole build your business up and sell it is you typically only sell a business once or twice. And Jeremy talks about this, and yet you're going into this, like, so the capital markets is the ultimate, where you're going into an industry where people have been working at this for 30, 40, 50 years. They're competing in a Shark
Den, basically walking into. Or Shark Tank.
It's just crazy. And the idea that, a first time entrepreneur taking their company public is going to stand a chance in that environment. And even if you've got the best advisors in the world, they're playing a different game from you. It's, they'll say all the right things, but at the end of the day, it's your brand, it's your reputation. And oftentimes it's your family and friends, staff that put money into it as well. And so when it goes wrong, it's a super, super, very public kick in the nuts. And you see a lot of people don't recover from that. Actually, I did an interview. Do you remember Gerald Ratner? You grew up in the UK.
Yeah.
So Gerald Ratner was this famous jeweler that made a joke about his products being crap and not lasting as long as an M&S sandwich. And he got beaten up in the media, and his share price tanked, and ultimately he was fired by his board. But I did a great interview with him about the lessons he'd learned and moved on from that. But like a lot of entrepreneurs don't come back from that, and so I think that there is sort of whether it's selling to private equity who will try and screw you out of as much as possible because that's their business model, public markets where you're just fighting a market, an audience you don't understand, or private buyers that quite possibly either don't know what they're doing either, or they've got lots of experience and will be playing a different game. So it is, it can be tough, and it's why and this is why I'm a big advocate for having advisory boards and getting smart people around you to help you so you don't kind of, make too many costly mistakes. You're always going to make some mistakes, but
No, I mean, that was my experience. Seriously, my first company, uh, the, when I sold it, it was just a private trade buy, but they were 20, 30 years older than me. They'd bought and sold many companies. They said all the things that I wanted to hear, like you'll be an exited founder in your 20s, we'll hype the thing up and it will all be wonderful. And same in terms of the deal terms, weirdly kind of gave me everything that I thought I wanted, but perhaps didn't. And, if I'd known what I often say that if I'd known what I know now, definitely left millions on the table, should have got some advisors around me, etc. And it probably took me a few years mentally to kind of like put that in the past and then dust myself off and then get back on the horse and go again. But you're right. I mean, if it's particularly if people have never done it before, then the likelihood is you're probably going to smack your face at least the first 5 times. So, why not actually get some folks around you who can help you, who probably made those 15 mistakes before you.
Yeah, definitely. And then being a dumb entrepreneur, we won't listen to them anyway.
No, exactly. I know better. Anyway, the final thing I wanted to touch on actually is because we talked about partnerships in different ways, but I also think talking about business partnerships. So you and Jeremy have worked together for over a decade. What do you think is the secret to maintaining successful business partnerships over many years? Because so often, they fall apart, or people, for whatever reason, something happens, or life events happened, or someone screws the other person over or something. But how do you build successful long-term business partnerships?
I don't think either of us were particularly looking for a partnership. We were both sort of successful entrepreneurs in our own right, and just started working together. And it was the agglomeration was Jeremy's idea, and it solved such a big problem for me as an entrepreneur that I couldn't believe that we couldn't do something more with it, help more people. And it's worked very well. We've obviously been through, we've had lots of peaks and lots of troughs along the way, and we just happen to work very well together. I think, what I talk about in progressive partnerships is this idea of low expectations and plenty of communication. And I think where most partnerships break down is you expect your partner to be on 100% of the time, and to just be this great person all the time, and that's not how stuff works. I've been with my wife for 30 years, and I constantly have to remind her to lower her expectations, and but that's how it works. So I think look, I'm sure there's probably partnerships that haven't worked.
But there's definitely lessons. I mean, the two of you are successful in your own right, which I think is a good start, because I've seen them go wrong where maybe one person's really successful, the other one person might be desperate to do something, and then there's kind of inevitably a bit of an imbalance there. So it's kind of there's something there, and then low expectations. I think I've definitely had that where perhaps some of the earlier business partnerships had super expectations about someone or something, and then got very frustrated when it didn't happen.
To be clear, this isn't that I've got low expectations on Jeremy. It's that I have low expectations about a partnership. And look, I think we just have we're both creative. We both enjoy doing what we do and have fun doing it together. And even when things are tough, you kind of know that you're going to have fun again. And I think what we have done quite well, or very well, I'd say, is that we've got a team around us that complements us. So and that team has worked with us for years, but both Jeremy and I are, we're out front talking about the deals and the opportunities and that sort of stuff. Neither of us are particularly good at doing the follow-up and sort of getting
Really,
in.
it shocks me knowing both of you quite well.
So we sort of have a rule that one of the team has to be on the call with us when we're talking to a client or an investor, because the first couple of years we would just have these amazing conversations and they
great chats, and then
anywhere.
And then 4 months later you remember, oh yeah, I remember speaking to so and so about that thing. What never happened, weirdly.
Email, really. Should have got their bank
that hasn't happened. Yeah. No, makes
so,
sense. Okay.
Yeah, we've kind of proceduralized around us to cover our weak points and got a team that
makes sense.
So
but I mean, you're both, brilliant at that side of the public facing side of things, and then to have the team and capability behind, I guess, makes the whole thing work. Final thing, then, what's next? What are you excited about next? Because obviously hundreds of companies that want to work with the models that you've been talking about, but what's next?
I was having this conversation today with someone actually. The weird thing is, we've got a $100 million fund, which is a bond that pays 15% a year. We've got all of these groups of public companies that are either public or taken public and growing to multi-billion. We're still a tiny company. Unity Group is like a dozen people scattered around the world. And what I was saying to this, it was actually an investor this morning, is small companies are so isolated from the economy. So you've got this weird, today the economy is weirder than ever. It shows signs of being at all-time highs and all-time lows at the same time. But when you're a small business, one client, so it could be a booming economy, but if you lose your biggest client, you can have a nightmare year. Conversely, the economy can be horrendous, but one client can make that your best year ever. We're more diversified now, but we're still small enough that when we've got momentum, things are really fun. And I think we've been doing this sort of long enough now, for 10 years, and built up enough profile and enough ecosystem around us that we sort of have this pretty consistent flow of good companies and good people around us that filter a lot of opportunities and just bring us the good ones. And I'm really, really excited. There's lots of cool stuff happening, and then AI is
off the
that's something outside.
No. I mean, it's so inundated with stuff that the phone's ringing off the hook or whatever.
That's probably the Prime Minister.
Exactly.
But so, and then there's AI, which is kind of the big unknown. But I'm more excited than I am worried about that.
Yeah, no, for sure. We could talk for another hour about that. That's probably for part 2 when you're in Dubai.
Excellent. Look forward to it.
Well, thanks very much. Really appreciate you joining, Callum. And it's been a great conversation. Thank you.
Cool. I'll see you in Dubai.
So I hope you enjoyed today's conversation. And if you did, then you should get on our list, because we will be sharing exclusive behind the scenes. We'll be sharing more content, more materials. We'll also be sharing who are the upcoming guests, so you can prepare for that. You can ask questions and you can really start to be part of a community. Head below, click the link, join the list, and we'll see you next time. Thanks for watching.